A bond is simply a promise to pay a series of cash flows, regular coupons, and the face value at maturity. Valuing a bond is the same as asking, how much would I be willing to pay today to receive those future payments? The answer is the present value (PV) of each cash flow, discounted at the market required yield (I). Mathematical setup. For a bond with face value F, annual coupon rate C paid semi-annually, quarterly, etc., number of periods N, and market yield per period I, the price P is equal to the sum from T equals 1 to N of C sub T divided by 1 plus I to the T, plus F divided by 1 plus I to the N. Here C sub T is the coupon paid in period T if coupons are level. C sub T equals C times F divided by M, where M is the number of coupons per year. Numerical example. Imagine a 5-year, 6% annual coupon bond, face value $1,000, paying coupons once a year. The market yield is 5%. Coupon each year, C equals 0.06 times 1,000, which equals 60. Discount factor for year T, 1 divided by 1.05 to the T. Present value of coupons equals 60 times open parenthesis 1 over 1.05 plus 1 over 1.05 squared plus 1 over 1.05 cubed plus 1 over 1.05 to the fourth plus 1 over 1.05 to the fifth close parenthesis, which equals 60 times 4.3295, which equals 259.77. Present value of principal equals 1,000 divided by 1.05 to the fifth, which equals 1,000 divided by 1.2763, which equals 783.53. Total price equals 259.77 plus 783.53, which equals 1,043.30. Because the coupon 6% is higher than the market yield 5%, the bond trades above par. Real-world analogy: think of a series of monthly rent checks you will receive from a tenant. To know how much you would pay now to buy the lease, you discount each future rent payment by the return you could earn elsewhere, the market yield. The same logic works for bonds. Yield measures tell investors how much return they can expect expressed as a percentage. They differ in what cash flows they consider. 2.1 Yield to maturity (YTMs). YTM is the single discount rate that makes the present value of all expected cash flows, coupons plus principal, equal to the current market price. It assumes you hold the bond to maturity and reinvest coupons at the same YTM. Present value equals the sum from T equals 1 to N of C over 1 plus YTM to the T, plus F over 1 plus YTM to the N. Because the equation is nonlinear, we usually solve it by iteration, Newton-Raphson, or financial calculators. Example: same bond as before, price $1,043.30, face $1,000, coupon $60, N equals 5. Plug into a calculator gives YTM approximately 4.23%, lower than the coupon because the price is above par. 2.2 Current yield. Current yield is a quick rough measure, annual coupon divided by current price. Current yield equals coupon divided by price. Using the numbers above, 60 divided by 1,043.30 equals 5.75%. It ignores the capital gain component, price returning toward face value, and the time value of future coupons, so it is less accurate than YTM. 2.3 Yield to call (YTC). Many bonds have a call option. The issuer can redeem the bond before maturity at a predetermined call price C sub price. YTC assumes the bond is called at the earliest possible date and uses cash flows up to the call date. Present value equals the sum from T equals 1 to N call of C over 1 plus YTC to the T, plus C sub price over 1 plus YTC to the N call. Example: suppose the same bond is callable after 3 years at $1,020. Price still $1,043.30. Solve for YTC. 1,043.30 equals 60 over 1 plus YTC plus 60 over 1 plus YTC squared plus 60 plus 1,020 over 1 plus YTC cubed. Iterating gives YTC approximately 3.56%. Because the issuer can call the bond when rates drop, investors demand a lower yield for callable bonds. Analogy: think of a lease that can be terminated early by the landlord call. The yield to call is like the return you would earn if the landlord ends the lease at the earliest date. 3-point pricing bonds with different coupon frequencies, and day count conventions illustrative case. In practice, coupons are not always paid annually. They can be semi-annual, quarterly, or even monthly. Moreover, the exact number of days between coupon dates matters. This is captured by day count conventions, for example, 30/360, actual over actual. 3.1 Frequency adjustment. If a bond pays coupons M times per year, the per period coupon is C equals C times F divided by M, and the per period yield is I equals Y divided by M, where Y is the annual nominal yield. The price formula becomes P equals the sum from T equals 1 to N times M of C divided by open parenthesis, 1 plus I close parenthesis to the T plus F divided by open parenthesis, 1 plus I close parenthesis to the N times M. 3.2 Day count example. Suppose a 2-year bond with 5% annual coupon, face $1,000, pays semi-annual coupons. Market annual yield equals 4% quoted on a 30/360 basis. Per period coupon, C equals 0.05 times 1,000 divided by 2 equals 25. Per period yield, I equals 0.04 divided by 2 equals 0.02. Number of periods, N times M equals 4. Price, P equals 25 times open parenthesis 1/1.02 plus 1/1.02 squared plus 1/1.02 cubed plus 1/1.02 to the fourth close parenthesis plus 1,000 divided by 1.02 to the fourth. I'll compute. PV coupons equals 25 times 3.7135 equals 92.84. PV principal equals 1,000 times 0.9238 equals 923.84. P equals 1,016.68. Because the coupon rate 5% exceeds the yield 4%, price greater than par. Day count nuance. If the bond used actual over actual instead of 30/360, the exact number of days between coupon dates would affect the accrued interest and the effective per period yield. For example, a period of 182 days versus 184 days would slightly change I. Analogy, imagine you receive a salary every 2 weeks versus monthly. To compare two job offers, you need to adjust the pay frequency to a common time unit, for example, annual. Likewise, bond pricing normalizes coupon frequency and day count to a per period rate. Construction of the zero coupon yield curve via bootstrapping step-by-step example. A zero coupon yield curve or spot curve tells the exact yield for a risk-free cash flow that occurs at a specific future date. Bootstrapping is the process of extracting these spot rates from a set of coupon-bearing securities, for example, treasury notes. Step-by-step illustration. Assume we have 3 treasury securities all with face $100 and their market prices. T1 maturity 1-year coupon 2.0% price, 101.00. T2 maturity 2 years coupon 2.5% price, 101.95. T3 maturity 3 years coupon 3.0% price, 102.90. All coupons are paid annually, and yields are quoted on an actual/actual basis. Step 1 1-year spot rate S1. For the 1-year bond cash flows are coupon plus principal at year 1 equals 2 plus 100 equals 102. 101 equals 102 divided by 1 plus S1. 1 plus S1 equals 102 divided by 101 equals 1.009900. S1 equals 0.009900 or 0.99%. Step 2 2-year spot rate S2. Cash flows for T2 year 1 coupon 2.5. Year 2 coupon plus principal equals 2.5 plus 100 equals 102.5. 101.95 equals 2.5 divided by 1 plus S, 1 plus 102.5 divided by 1 plus S2 squared. 2.5 divided by 1.0099 equals 2.475 approximately. 101.95 minus 2.475 equals 102.5 divided by 1 plus S2 squared. 99.475 equals 102.5 divided by 1 plus S2 squared. 1 plus S2 squared equals 102.5, divided by 99.475 equals 1.0304. 1 plus S2 equals square root of 1.0304 equals 1.0151. S2 equals 0.0151 or 1.51%. Step 3 3-year spot rate S3. Cash flows for T3 Year 1 Coupon 3, Year 2 Coupon 3, Year 3 Coupon plus principal equals 3 plus 100 equals 103. 102.90 equals 3 divided by 1 plus S1 plus 3, divided by 1 plus S2 squared plus 103, divided by 1 plus S3 cubed. 3 divided by 1.0099 equals 2.970. 3 divided by 1.0151 squared equals 2.912. 102.90 minus open parenthesis 2.970 plus 2.91 2 close parenthesis equals 96.0. 18 equals 103 divided by 1 plus S3 cubed. 1 plus S3 cubed equals 103 divided by 96.0. 18 equals 1.0726. 1 plus S3 equals the cube root of 1.0726 equals 1.0236. S3 equals 0.0236 or 2.36%. Resulting zero coupon curves. 1-year spot equals 0.99%. 2-year spot equals 1.51%. 3-year spot equals 2.36%. These spot rates can be used to price any cash flow occurring at those maturities by simple discounting. Analogy: think of building a staircase where each step S height depends on the previous steps. You measure the height of the first step directly, then use it to infer the second step S height. And so on. Bootstrapping works the same way. Each new spot rate is solved using already known earlier rates. 5.1 Macaulay duration D sub mac. D sub mac equals the sum from T equals 1 to n of T times cash flow T divided by open parenthesis 1 plus y close parenthesis to the T, all over the sum from T equals 1 to n of cash flow T divided by open parenthesis 1 plus y close parenthesis to the T. CF sub T equals cash flow at time T, y equals per period yield, YTM. The denominator is just the bond price. 5.2 Modified duration D sub mod. D sub mod equals D sub mac divided by 1 plus y. It approximates the percent price change for a small change in yield, delta y. Delta P over P is approximately negative D sub mod times delta y. Sample problem. Consider a 3-year semi-annual coupon bond. Face equals $1,000. Coupon equals 4% annual, 2% each half year. Cash payment C equals 20 every 6 months. Yield equals 3% annual, 1.5% per half year. Number of periods equals 6. Step 1. Compute price. P equals sum from T equals 1 to 6 of 20 divided by open parenthesis 1.015 close parenthesis to the T, plus 1,000 divided by open parenthesis 1.015 close parenthesis to the 6, equals approximately 1,023.30. Step 2. Compute weighted cash flow times. T equals 1, cash flow 20, discount factor 1.015 to the minus 1 equals 0.98522. Present value 19.70. T times present value 19.70. T equals 2, cash flow 20, discount factor 1.015 to the minus 2 equals 0.97078. Present value 19.42. T times present value 38.84. T equals 3, cash flow 20, discount factor 1.015 to the minus 3 equals 0.95665. Present value 19.13. T times present value 57.39. T equals 4, cash flow 20, discount factor 1.015 to the minus 4 equals 0.94280. Present value 18.86. T times present value 75.44. T equals 5, cash flow 20, discount factor 1.015 to the minus 5 equals 0.92923. Present value 18.58. T times present value 92.90. T equals 6, cash flow 1020, discount factor 1.015 to the minus 6 equals 0.901592. Present value 934.44. T times present value 5606.64. Sum of present values equals 1023.30. Sum of T times present values equals 5891.31. Step 3, Macaulay duration. D sub mac equals 5891.31 divided by 1023.30 equals 5.76 periods, which equals 2.88 years. Step 4, modified duration. D sub mod equals 5.76 divided by 1 plus 0.015 equals 5.68 periods, which equals 2.84 years. Step 5, price sensitivity. If yields rise by 10 basis points, which is 0.0010 annually, that is 0.0005 per half year, delta P over P is approximately negative 2.84 times 0.001 equals negative 0.284%. The price would fall about $2.90 on a $1,023 bond. Analogy: think of a seesaw lever. The longer the arm, which represents duration, the more the seesaw tips when you add a small weight, which represents an interest rate change. Modified duration tells you exactly how steep the tilt will be. Duration gives a linear approximation of price change, but bond price-yield relationships are actually curved. Convexity captures this curvature, improving the estimate for larger yield moves. C equals 1 divided by P times the sum from T equals 1 to N of cash flow sub T times T plus 1 divided by 1 plus Y raised to the power of T plus 2. Modified convexity C mod equals C divided by 1 plus Y squared. Units are years squared. Delta P divided by P approximately equals negative D mod times delta Y plus 1/2 times C mod times delta Y squared. The convexity term adds back some price because the price curve is convex upward. Use the same bond from the previous example. Price $1,023.30, D mod equals 2.84 years. Compute convexity. For T equals 1, cash flow is 20, T times T plus 1 is 2. Discount factor 1.015 to the negative 3 is 0.943. Contribution 20 times 2 times 0.943 equals 37.72. For T equals 2, cash flow is 20, T times T plus 1 is 6. Discount factor 1.015 to the negative 4 is 0.928. Contribution 20 times 6 times 0.928 equals 111.36. For T equals 3, cash flow is 20, T times T plus 1 is 12. Discount factor 1.015 to the negative 5 is 0.914. Contribution 20 times 12 times 0.914 equals 219.36. For T equals 4, cash flow is 20, T times T plus 1 is 20. Discount factor 1.015 to the negative 6 is 0.900. Contribution 20 times 0.900 equals 360.00. For T equals 5, cash flow is 20, T times T plus 1 is 30. Discount factor 1.015 to the negative 7 is 0.886. Contribution 20 times 30 times 0.886 equals 531.60. For T equals 6, cash flow is 1020, T times T plus 1 is 42. Discount factor 1.015 to the negative 8 is 0.872. Contribution 1020 times 42 times 0.872 equals 37,329.6. Sum of contributions is 38,590.64. Now convexity C equals 38,590.64 divided by 1023.3 equals 37.73. Modified convexity C mod equals 37.73 divided by 1.015 squared equals 36.62. Effect on price for a 50 basis point rise, delta Y equals 0.005 annually, which is 0.0025 per half year. Duration only estimate delta P over P approximately equals negative 2.84 times 0.005 equals negative 1.42%. Convexity term 1/2 times 36.62 times 0.00 5 squared equals 0.004578, which is 0.0458%. Combined estimate delta P over P approximately equals negative 1.42% plus 0.046% equals negative 1.374%. Actual price change computed via ray discounting is about negative 1.36%, showing the convexity correction improves accuracy. Analogy: if duration is the slope of a hill, convexity is the curvature of the hill. Walking a short step down the hill, the slope gives a good idea of how far you drop. But if the hill bends convex, the actual drop is a little less steep than the straight line slope predicts. Convexity accounts for that bend. Parallel shift: all maturities move by the same amount. For example, every point on the curve rises 25 basis points. The price impact on a bond is well captured by duration and convexity. Example: the portfolio holds 2 bonds. Bond A is a 2-year bond with a duration of 1.9 years and a weight of 60%. Bond B is a 10-year bond with a duration of 8.5 years and a weight of 40%. Portfolio duration equals 0.6 times 1.9 plus 0.4 times 8.5, which equals 4.26 years. If the curve shifts up 30 basis points, the estimated portfolio loss is approximately 4.26 times 0.003, which equals 1.28%. Non-parallel twist, also called steepening or flattening. Short-term rates move differently from long-term rates. In a steepening scenario, short rates fall while long rates rise. Long-duration bonds lose value and short-duration bonds may gain. Example: using the same portfolio, now the short end, the 2-year rate falls 10 basis points, so the price of bond A rises approximately 1.9 times negative 0.001, which is negative 0.19%, a gain. The long end, the 10-year rate, rises 20 basis points, so the price of bond B falls approximately 8.5 times 0.002, which is 1.70% loss. The portfolio change is approximately 0.6 times negative 0.19% plus 0.4 times negative 1.70%, which equals negative 0.79% overall loss, larger than the parallel shift estimate because the curve twist hurts the long bond more. Butterfly or curvature move: midterm rates move opposite to short and long ends. For example, 5-year rates rise while 2-year and 10-year rates fall. Bonds with cash flows near the middle are most affected. Example: add a 5-year bond with a duration of about 5 and a weight of 10%. If the 5-year spot rises 25 basis points while the 2-year and 10-year each fall 10 basis points, the 5-year bond experiences a loss of approximately 5 times 0.0025, which is 1.25%, while the others gain modestly. Portfolio impact depends on the weight placed on the middle maturity. Portfolio impact tools. Key rate duration, or KRD, measures sensitivity to a shift at a specific maturity bucket while keeping others unchanged. By summing key rate duration times the shift for each bucket, you obtain a more precise loss estimate for non-parallel moves. Immunization matches portfolio duration to the investment horizon and uses convexity to protect against small parallel shifts. For non-parallel risk, managers may use sector swaps or forward rate agreements to hedge specific key rates. Analogy: think of a boat on water. A parallel shift is like the whole lake level rising uniformly, so the boat simply floats higher or lower. A twist is like a wave that is higher at the bow than the stern, tilting the boat. A butterfly is a hump in the middle of the lake, causing the boat to dip in the center. Duration is the tilt angle for a uniform rise. Key rate duration tells you how the boat reacts to each separate wave. Question 1 – Duration convexity approximation. A 4-year bond pays a 5% annual coupon semi-annually, has a face value of $1,000, and a current yield of 4.5% quoted semi-annually. Estimate the price change if the yield rises by 20 basis points 0.2%.
A solution sketch.
1. Compute price, Macaulay duration, and modified duration. Use the semi-annual yield 2.25%. Students can use a financial calculator. Result: approximately price $1,035, DMOD approximately 3.7 years. 2. Compute convexity modified using formula yields about 17. 3. Apply combined formula. Delta P over P approximately negative 3.7 times 0.0020 plus 0.5 times 17 times 0.0020 squared. equals negative 0.0074 plus 0.000034 equals negative 0.007366. So price falls approximately 0.7366%, loss approximately $7.63 on a $1,035 bond.
Question 2 Immunization.
An investor has a liability of $500,000 due in 5 years. She can invest in a 2-year zero-coupon bond yield 3% and a 7-year coupon bond annual coupon 6% yield 4%. Determine the allocation that immunizes the liability, match duration, and present value.
A solution sketch.
1. Compute present value PV of liability PV_L equals 500,000 divided by open parenthesis 1.03 close parenthesis to the 5th power equals 432,000.
2. Compute duration of each asset. 2-year zero duration equals 2 years.
7-year coupon bond calculate Macaulay duration approximately 5.8 years, and then modified approximately 5.58. 3. Let X equals amount invested in 500,000 minus X in coupon bond. PV matching X divided by open parenthesis 1.03 close parenthesis squared plus open parenthesis 500,000 minus X close parenthesis times P 7-year equals 432,000. Solve for X. Duration matching open parenthesis 2 times PV 0 plus 5.58 times PV 7-year close parenthesis divided by PV total equals 5 years. Solve the two equations. Required allocation approximately $150,000 in the 2-year zero and $282,000 in the 7-year bond. Remaining cash used for settlement. The portfolio's duration equals the liability horizon immunizing against small parallel shifts.
Question 3 Yield curve shift implications. Your portfolio consists of 3 treasury securities.
1-year price $101 key rate duration 0.9. 5-year price $98 key rate duration 4.5. 10-year price $95 key rate duration 8.2. A market analyst expects the 2-year rate to fall 15 basis points, the 7-year rate to rise 10 basis points, and all other rates stay unchanged. Estimate the portfolio's percentage change using key rate durations.
A solution sketch.
1. Assume each security's KRD is primarily driven by the nearest key rate approximation. 1-year security reacts to 1-year rate no change. 5-year security reacts to 2-year and 7-year shifts. Allocate proportionally 60% sensitivity to 2-year, 40% to 7-year. Change equals 0.6 times 4.5 times negative 0.00, 15 plus 0.4 times 4.5 times 0.0010 equals negative 0.00405 plus 0.0018 equals negative 0.00225, negative 0.225%. 10-year security reacts mainly to 7-year shift change, equals 8.2 times 0.0010 equals 0.0082 0.82%. 2. Weight by market value total MV equals 101, plus 98 plus 95 equals 294. Portfolio change equals open parenthesis 101 divided by 294 close parenthesis times 0 plus open parenthesis 98 divided by 294 close parenthesis times negative 0.225% plus open parenthesis 95 divided by 294 close parenthesis times 0.82% approximately negative 0.075% plus 0.265% equals positive 0.19%. Thus the portfolio is expected to gain about 19 basis points.